The CME halted trading in metals and options today. At 12:11 Central Time, the screens froze. By 12:15, the halt was confirmed. All-day orders and GTDs expiring today were canceled. GTC orders survived. That's the fact. Everything that follows on the internet tonight will be interpretation. And I'm recording this video specifically to separate the two before the interpretation costs you money. Because here's the timing that has the entire metals community on fire right now. This halt happened 48 hours before first notice day for the March 2026 silver contract. 48 hours. And when the plumbing of the world's most important commodity exchange freezes exactly when the delivery calendar gets sensitive, the internet doesn't ask what broke. The internet asks who benefits. Today I'm going to walk you through the mechanics of what happened, show you why the timing matters structurally, explain why your brain is about to lie to you about what it means, and give you a 5-signal checklist for the next 48 hours that will keep you on the right side of this event. No drama, no conspiracy, just a framework for thinking clearly when everyone around you is stopped. Ken AG here, data over narrative. Let's work through this. Disclaimer. Education. Nothing in this video is financial advice. I'm not telling you to buy, sell, or hold anything. The rule on this channel is simple. If it can't be proven, I don't treat it as fact. Before we touch the halt, let me give you the price context because numbers anchor everything. Silver on the COMEX is sitting near $89. Silver on the Shanghai Futures Exchange is around $106. That's a $17 premium. Gold is above $5,170. And first notice day for the March silver contract, SIH26, is February 27th, 2 days from now. That's the landscape into which this technical event just landed. Now, let me tell you exactly what a trading halt is and what it isn't. Because most of the commentary you'll see tonight gets this fundamentally wrong. No trades execute, no prices update. The market is effectively frozen. This can happen for many reasons. Technical failures in the matching engine, data center issues, network disruptions, software errors, or, and this is important, it can be triggered deliberately by the exchange when the system detects anomalies that could compromise market integrity. What a halt is not, without specific evidence, is proof of manipulation. I want to be very clear about that, not because manipulation doesn't exist in commodity markets. It does. It's documented. It's been prosecuted. But because a technical halt by itself is an infrastructure event. Calling it manipulation without evidence is exactly like calling a power outage a conspiracy. Power outages happen. Sometimes the timing is suspicious. But suspicious timing is not proof. It's a coincidence that your brain is wired to interpret as causation, and that wiring is about to become your biggest risk. Let me explain why. There's a term in psychology called apophenia. It means the human tendency to perceive meaningful patterns in random or unrelated information. Your ancestors survived because they were pattern recognition machines. The ones who heard a rustling in the grass and assumed predator lived to reproduce. The ones who assumed wind did not. Your brain is descended from millions of years of false positives being safer than false negatives. And that served you well on the savannah. It serves you terribly in financial markets. Because in financial markets, seeing patterns that aren't there leads to trades based on narrative instead of data. And trades based on narrative are how retail investors consistently transfer wealth to institutional participants who trade based on positioning. So when the CME halts metals 48 hours before first notice day, and silver is at $89 and Shanghai is at $106 and inventory is tight, your brain does something automatic. It connects every dot into a single story. They stopped the market to prevent a squeeze. They froze the system to buy time. They halted trading to protect the shorts. And that story feels true. It feels obvious. It feels like the only possible explanation. But feeling obvious is not the same as being provable. And in this business, the distance between those two things is where most money gets lost. Now, having said all that, let me give the timing its due, because dismissing the timing would be just as intellectually dishonest as overinterpreting it. First notice day is February 27th. That's the first day on which longs can formally notify the exchange that they intend to take physical delivery of the March silver contract. It's a pressure point, not because it guarantees stress, but because it reveals intent. How much open interest is still standing when that bell rings tells you how many participants want metal versus how many want paper. And that revelation, in a market where registered inventory sits at multi-year lows and the Shanghai premium is running $17 above Western spot, carries weight. A trading halt 48 hours before that revelation doesn't cause a delivery problem, but it does amplify uncertainty. And uncertainty, in a market that's already running on tight inventory and elevated premiums, is combustible. Here's the mechanism. When a halt occurs, it interrupts continuous price discovery. Orders accumulate during the freeze. Participants can't adjust their positions. Risk managers can't hedge. And when the market reopens, all of those accumulated orders collide simultaneously. Academic research on trading halts consistently shows the same pattern: temporary increase in volatility, surge in volume, wider bid-ask spreads, reduced depth. The halt doesn't create new risk, it compresses existing risk into a smaller window. It's the difference between releasing water from a dam gradually and opening the floodgates all at once. The total water is the same. The impact is not. Now apply that to the current context. Silver is 48 hours from a delivery deadline. Registered inventory is near multi-year lows. Shanghai is paying 106. The arbitrage incentive to pull metal east is extreme, and the system just experienced a halt that will compress all accumulated risk into the reopening session. The reopening candle is going to be volatile, the spread is going to be wider, and every piece of that volatility is going to be interpreted through the lens of whatever narrative the viewer brought into the day. If you came in bullish, the halt confirms the squeeze. If you came in bearish, the halt confirms the exchange is maintaining order. Same event, two opposite interpretations. Both feel equally certain. Neither can be proven by the halt alone. That's why I'm giving you a checklist instead of a conclusion. Let me also address the elephant in the room, the last major CME halt. In late November 2025, the CME experienced a significant outage related to a data center cooling failure. Reuters covered it. The exchange was down for hours, and in the 60 days that followed, silver rallied substantially. Social media immediately drew a causal line. The halt caused the rally. The halt was designed to suppress the price before the move. Let me offer the professional framing. The market was already stressed before the halt. Inventory was draining, deficits were accumulating, macro conditions were deteriorating. The halt happened during a period of pre-existing pressure, and the rally that followed was driven by the same supply-demand fundamentals that were in place before, during, and after the outage. Correlation is not causation, and in a market that was already trending higher on structural deficit, attributing the move to an infrastructure event is like attributing the sunrise to your alarm clock. They happen at the same time. One does not cause the other. That doesn't mean the halt was irrelevant. Infrastructure events expose operational risk. They erode trust. They add uncertainty to an already uncertain environment. And uncertainty, as we've discussed, amplifies existing trends. So the halt may have accelerated a move that was going to happen anyway. But accelerating and causing are different verbs. And in risk management, the difference matters. Now, your checklist for the next 48 hours. 5 signals, all verifiable, all public, no interpretation required. Signal 1, the CME Silver Delivery Calendar. First notice day is February 27th. Mark it. Watch how much open interest is still standing when the deadline arrives. If it's elevated relative to registered inventory, delivery stress is real. If it's collapsed, the roll worked and the system cleared. Signal 2. The CME Daily Silver Stocks Report. This is a public Excel file updated daily. It breaks down registered versus eligible inventory. Watch registered specifically. Is metal flowing in, which would suggest preparation for delivery, or flowing out, which would suggest tightening at the worst possible moment? The direction of registered inventory in the next 48 hours tells you more than any tweet. Signal 3. The SHFE versus COMEX spread. Shanghai silver futures are denominated in yuan per kilogram. Convert to US dollars per troy ounce using the current exchange rate. Compare to COMEX spot. If the premium widens beyond $17, physical urgency is increasing. If it narrows toward $10, the market is finding equilibrium. The spread is your thermometer for the physical market's temperature. Signal 4, margin and operational adjustments. After volatile episodes, exchanges frequently raise margin requirements. We've seen this happen recently in metals. A margin hike forces undercapitalized participants to either add funds or close positions. It thins the market. It changes the composition of who's still in the game. If the CME announces a margin increase between now and Friday, pay attention. It's the exchange's way of managing risk. And the fact that they need to manage risk tells you the risk is real. Signal 5. And this is the one nobody else will tell you to watch. Your own bias. When you feel like this can only mean one thing, you're entering an apophenia loop. When the halt confirms exactly what you already believed, your pattern recognition machine is running on autopilot. And autopilot in volatile markets is how you end up on the wrong side of a trade that felt absolutely certain at the time. The professional doesn't eliminate bias, they manage it. They notice when the feeling of certainty spikes, and they slow down instead of speeding up. They ask, what would I think about this halt if I had the opposite position? And they let that answer inform their risk management, not their conviction. What happened today was a technical event. The timing was sensitive, the context is explosive, and the next 48 hours will determine whether this becomes a footnote or a chapter. But the outcome won't be determined by the halt. It'll be determined by inventory, delivery demand, premiums, and the same structural forces that were in motion before the screens froze. The halt didn't change the fundamentals, it changed the noise level. And in this market, the person who can separate signal from noise in real time has an edge that no algorithm can replicate. Watch the data, not the drama, and I'll see you on the other side of First Notice Day with a full breakdown of what the delivery numbers actually tell us. If this framework helped you think clearly about today's halt, instead of reacting emotionally, hit the like button. It's the single best way to make sure this kind of analysis reaches people before the narrative machine buries it. Leave a comment. Tell me your read. Technical failure or something else? Show your reasoning. I'll engage with the best analysis. Subscribe and hit the bell. Friday's First Notice Day coverage is going to be critical. You need to be here for it. Share this with someone who saw the halt headline and panicked. As always, take care of yourself and each other. Your friend, Ken AG. Build that stack, but build it with data.